Welcome back to the Stay Broke podcast. Today, we're diving into the topic that every successful business owner will eventually face, the exit. Whether that means selling, merging, or passing it down, your existing strategy is one of the most important decisions you'll ever make. Our guest today knows that process inside and out. Dan Wilson, managing partner at Viking Mergers and Acquisitions in Raleigh, North Carolina. Dan built and sold his own multi-million-dollar IT company before dedicating his career to helping other business owners do the same. He's a U.S. Air Force veteran and certified exit planning advisor and a certified M&A professional who's worked with hundreds of entrepreneurs to navigate the biggest financial transaction of their lives. Dan, welcome to the podcast.
Yeah, thank you for having me.
Absolutely. So, like we were just talking about before we started, the way we met was I was kind of getting overwhelmed with the different businesses I was into, and my utility company I knew had the most value in it, and we were making a lot of big changes, and I did a little research. I like dealing with local companies, so I did some research online, found you, reached out to you, and then we went through, I guess the evaluation process. We told you we weren't ready yet. You said there's benefits to going ahead and doing it now, and then we can do it again later. It was a good process, easy. Didn't feel judged. Felt like you knew what you were doing and you were guiding us through it. So it was a good experience, and that's why bringing you on as a guest I thought would be a good thing, because here on the podcast and in our consulting business, one of our main focuses is helping people find the exit strategy. I'm sure you know the statistics. Most of the businesses, like 65-75% of businesses are owned by 55 and over. And over the next 10 to 15 years, they say it's going to be the biggest transition in wealth because of business sales.
You know, you're taking my lines.
I know. But this is something that I'm preaching. So it's easy to research this, but this is what you do every day. So having you be able to back it up today and talk about the importance of what you do, but also what we do to help prepare people to get ready for that, to get ready for you. It's very complimentary. So since I stole half your talk, let's jump in. Tell us who you are and where you're from, kind of your background.
Sure. Well, you already know my name, Dan Wilson. My background is a military brat. So I lived in 7 different states by the time I was in the 6th grade. So I think moving around a lot and being the new kid everywhere, I learned how to make friends really quick. And after junior high and high school was in Panama City Beach, Florida, a really tough place to be during your teenage years. But I got through it. It was tough. Joined the Air Force shortly after that. Spent 12 years in the Air Force, all IT related. Got a lot of great experience working for some really good high-tech type stuff. And after I exited the military, within about 2.5 years, I had the opportunity to start my own business. My wife would call me the accidental entrepreneur. Just kind of, had the opportunity arise there. I call myself the opportunistic entrepreneur. And then, so started the company and figured out how to run it over the years and all that. And once said I got my MBA from Barnes & Noble, just reading every book I could get my hands on to figure out all the different aspects of what you need to do when you're running a business. And owned that for 16 years. Did a couple acquisitions, merged, rolled over some equity when I did that merger and exited completely a couple years after. And then within probably 5 months after that, I joined Viking as in the partnership group, opened the office here in Raleigh, North Carolina in September of 2019. So we're actually headquartered in Charlotte and have 18 offices throughout the Southeast.
Okay. Yeah, I know you mentioned that you had different offices, and I have that trouble whenever I look for a local company and they'll say, oh, we have a remote office, in your area, and they might have one employee working from home, but you guys have actual offices spread out. And that's, what I found out is that you guys were actually here in Raleigh whenever we decided to meet with you. So that was good. What other cities are you guys in?
Well, Baltimore, DC, Richmond, Raleigh, Charlotte, Asheville, Greenville, South Carolina, Charleston, Chattanooga, Knoxville, Nashville, Austin, Dallas, Houston, Tampa, Jacksonville, and Fort Lauderdale.
Okay. Awesome. And then is every location owned by like a managing member?
There's a managing partner for each location.
Okay.
And there's usually at least 2 to 3 additional people in the office. Some, I've got 5 in Raleigh. We've got 3 in Richmond. Charlotte's got 15, 16. Nashville, has got like 9. Tampa's got like 14. So the different offices are kind of different sizes depending on how long they've been around.
Okay. So your IT company, that was Waypoint Solutions?
Yep.
Right. So what inspired you to get into IT after the military? It was just that's what your experience was?
Yeah, I got out of the military and I was, certified Microsoft and Novell and Cisco and got a job directly out of the military in significantly raising my pay back in this was 1998. So it was a significant raise, and that was, the dot-com boom. So, technology and tech was going pretty strong. And as a global network engineer, and I was working directly with CSX, the railroad company, and at the time Sealand, the shipping company, which turned into Maersk. A lot of people heard, in Horizon Lines, and those were my first clients for my business when I created it. The tipping point, I guess, the event that gave that opportunity to start the business. A lot of people, depending on your age, maybe do or don't remember the name Bernie Ebbers with MCI WorldCom. He was the fraud that he committed with MCI WorldCom created Sarbanes-Oxley.
Yep.
Well, MCI WorldCom was the business. It was the company we were going through as contractors to do the work for CSX and Sealand. And when that all blew up, MCI WorldCom went away, and the 2, enterprise level companies were like, well, we still need these services. So they were going to contract them out. And I had the opportunity to put in a bid to win one of those contracts, and I won it and hired 2 people. Essentially I created my own job at the time and did that for a couple years. And then, the first 2 years, and after that I was like, oh, let me get another client and then another client. And I'm like, okay, I have a business here. And, I was having a great time running it and growing it. I love growing businesses. The running of the business after a while definitely takes its toll. I was ready to, after 16 years, I was ready to exit. I was burned out and it was time for something new. You know that feeling. That's why you called me.
Yep. So do you feel like the military prepared you at all to run your own business? Because I talk to a lot of veterans exiting that have the opposite experience. And I know it depends on what field you get into or what branch you get into, but where they have the leadership skills, but they know nothing about business and they're trying to reinvent themselves. And, we're talking with some of these veterans, trying to help guide them into that stuff. But I guess your experience it helped you?
Well, indirectly, yes. Depending on what you're going to do in the military, you're not going to get the ins and outs of what you need to do to run a business. However, the self-discipline that the military teaches you, the organizational skills, those come in. You need to have those to run a business, and those were instilled in me through the time I spent in the military. How to do financials or how to hire people or things like that. Those are things that you're just going to have to learn on the fly, or get taught. One of the things I did very early on after starting my business and obtaining the $1 million revenue mark is I joined the Entrepreneurs Organization, and that's a peer group that of a bunch of other business owners that you're going to be able to pull from their experience and the mistakes that they made and the successes they've had to kind of help you get through that.
Yeah, I know. Like you said, the leadership and all that, that was great to learn from the military. But I think the thing that I had to overcome after exiting and becoming an entrepreneur was sticking your head down and just keep pushing forward isn't always the best solution, because there's not other people to come behind you and clean the mess up.
Well, that's true. When you own the business, especially at the start, you wear in every hat of the company.
Yeah.
And like one of the things that I told you, and I tell a lot of the business owners that call and are interested in looking about selling their business or exiting, what their options are and all that, is a couple of things you need to do is you need to take as many of the hats off as possible. So, and you mentioned about exit strategies earlier on. I'm a firm believer every business owner needs to have an exit strategy that does not include 6 feet of dirt on top of them.
Yep, 100%. I know one thing I like about your story so far that I'm trying to get across to people too is you didn't just come out of the military, you're like, oh, I know how to do IT, I can just go try and jump in with the big guys. Like, you swam around in the industry with the big guys for a while and then waited for the right opportunity. And at that point, you probably had a better understanding of like how to bid, how the contracts work, stuff like that.
Yes. Yeah, I would definitely recommend getting a little bit of corporate experience, small business experience, so you can understand whatever aspect that you need to fill in the blanks with. I remember when I was, a couple years into the company, when I kind of rebranded it to Waypoint Solutions Group, because that wasn't the original name. And when I rebranded it, it was all right. We're going to go after small businesses and be their outsourced IT. That type of company is known today as a managed service provider, and this was like in 2004, 2005, when this was a fairly new term. And my wife worked for a private equity group, and during our trips that we would take with our girls, as they were watching usually Dirty Dancing, in the back of the SUV, her and I are talking, and I'm listening to the problem she has with work, and I'm like, oh, I can solve it this way. And she goes, well, what about this problem? So we kind of help put together, the things that the small businesses out there would need to have from an outsourced IT department, because it makes sense that you don't need to hire 3 people at 3 different levels when you can hire one company at a third of the cost that has the level 1 engineer all the way up to the the level 3 engineer. And so it was it was a team process and a lot of teamwork to involved, and then just kind of start putting the pieces together, and try, fail, and adjust. One of the things I said back then is, when you're building a business from the start, it's like building a jet engine for a plane while you're already flying.
Yeah.
It gets crazy sometimes.
It does. No, that's it. I've had like different businesses, construction companies that didn't work out long term for different reasons. But whenever I started the utility company, I was like, I'm going to do it different this time. And I actually went to work for the people that I wanted to be my customers. I went and worked for them for a year, and took all the experience I had gotten and decided I was going to build a business for them that they needed after I understood the industry. Mm-hmm. And I think that's why we've been successful. Whereas other times it's like, all right, I have a product or a service, I'm just going to go do it and start trying to sell my product and service with no real understanding of who the customers are and all that stuff. So
you got to understand your customers and solve a problem. When we were growing and all that, we didn't need to spend a huge amount of time in research and development and trying to figure out what else we needed to do. Our customers told us what was missing.
Yeah.
Wow, we'd really like to do this, or we need this, and that's where we're like, all right, let's add that service, let's add that product.
And then working as a sub for a couple of years, I guess you got the opportunity to really learn the industry and see what services were really needed and how to communicate with the customers, because that's mm-hmm. a whole different thing too.
Yeah.
So, was there any big surprises or anything that you wish you would have done a little different?
As you go through the years of owning a business, you learn things, and at the beginning and hiring people, I was always focused on the technical skills of the person, and then over time, as we developed a culture and core values and everything, I switched to hiring on the core values matches. You know, you can't teach that,
No.
right? But I can teach someone how to, you know, be a computer tech or a network engineer. We can teach that.
Right.
And it's the same thing when I'm hiring people and to work with us in Viking. You know, we've got a set of core values, and we look for those core values in the people and all that, because I can teach them how to look at financials. I can teach them how to look at tax returns and how to do evaluation and the process of M&A. But the soft skills and the human being that they are much more important.
100%. So as you started to exit, what did that process look like for you?
Crazy.
Yeah.
So, you know, I thankfully I had Jay Offerdahl, who's the founder of Viking, was a friend of mine that I met in EO. So any of the acquisitions that I did, or when I bought out a partner, and doing the merger, which a merger is, you do sell your company, you just don't sell all of it.
Right.
You know, and you can call that a merger. And he was always there to work out the kinks, or you know, whenever I had difficult questions, because there is an enormous amount of details that go into any acquisition or any merger that if you haven't done it before, it can be overwhelming, and it was, except for, you know, when Jay helped out and was able to get me through and understanding certain things and all that, and having the right attorney. What I mean by the right attorney is you want to have an M&A attorney whenever you're doing something like that, not an estate attorney,
Right.
all right, not a business law attorney. There's a different vernacular. You know, you wouldn't go to a pediatrician to have brain surgery. They both went to the same, you know, medical school, but they specialize. It's the same thing with law. So
Right.
you want to make sure that you get the professionals that are right in place on your team. That all goes down to your CPA too, and who your financial advisor is, and in understanding all those things. It's all part of your exit planning team that you're going to have around you.
Yeah. And you're not using your friend's wife's brother or something like that. You're trying to find real professionals that know what they're doing.
Yeah, it's one of the leading causes of deals, you know, dying on the vine, is, you know, having attorneys that aren't up to speed on the M&A process and all that. And, you know, they're going to do what attorneys are trained to do, and they're going to, I want to protect my client. Are you sure you want to do this? Well, why are you doing this? You should have got this.
Right.
And the next thing you know, the buyer or the seller is retrading a deal that was already made. And, you know, and now there's problems with the deal and all that, and distrust is happening, and why are you doing this? And one thing leads to another, and next thing you know, the deal is no longer on the table anymore.
Yeah.
From one side or the other. So, you know, when you're sitting across the table from a buyer and all that, and, you know, you shake hands and say, I'm good with this deal. Yeah, there's some details that need to be worked out, but the major components shouldn't be switched and changed just because a lawyer thinks that you could have gotten more.
Right.
Or you should have paid less.
And it doesn't happen overnight, right? Like these processes can take a while.
Yeah, our process, I mean, I would like to talk to a business owner at least 2 years, all right, before they're really ready to sell.
Okay.
And the reason for the 2 years is, depending on the size of their business, you know, we're going to do a valuation on the business, and we're really good at valuations. But what I'm going to tell every seller, and I believe I told you when we did your valuation and all that, it really doesn't matter what I tell you your value is. I'm going to tell you what the market's going to show for your business. Right. And if we go to market, these are the offers, the range that you're going to get. But when it comes down to it, your business is worth two things: what someone's willing to pay you for it, and what a bank's willing to loan them. Mm-hmm. And that second part is the reason why for the 2 years, because the bank is going to look back at least 2 years at the financials of the business, And if I'm the buyer for your business, I'm going to go to the bank and say I want to buy his business. They're first going to check me and my credit score, my finance ability and all that, make sure I'm credit worthy and all that. That checks the box. Now they're going to look and they're going to get your financials of the business, and they're going to look at this and like, how much are you paying for it? And they're going to look and see at the cash flow, and they're like, well, the cash flow of that business doesn't support the debt that you're going to put on the business by getting that loan. We can't loan you the money.
Right.
Well, I can't buy your business now. So when we do business valuations, we're ensuring that that the cash flow of that business has the sufficient cash flow to not only service the debt that could be put on the business, but also has a cash flow to pay the business owner something, all right, and still have cash flow to run the day-to-day operations of the business.
Yeah. So if the transition was so taxing, what made you decide to go into mergers and acquisitions yourself, going from founder to advisor?
Well, a couple reasons. Number one, I enjoyed the acquisitions that I did. I learned a lot from them. When you're combining, when you acquire another business and bring it into yours, it's challenging when the culture and making sure the cultures get merged. Number two, I went through a lot of the trials and tribulations and all that, and why not take those experiences and all that and help other business owners not have to go through some of the same pains.
Yeah.
And number three, Jay asked me. It was, I was looking at several other things to do, because I was 51 when I sold, something like that, 50. So I still had plenty of runway left. I wasn't gonna, not do anything. And he asked me one day, he's like, so what are you gonna do? I said, well, I'm gonna decompress for a couple months. And he says, well, when you're done decompressing, why don't you come join the Viking partnership team and open an office in Raleigh? I was like, oh, that sounds interesting. Well, a month later, I called him and said, hey, that question you asked me and all that, let's go have lunch. And after that lunch with him, I never thought about anything else. It was 100 miles an hour in that direction.
Yeah. I see. Did you use Viking for all of your mergers and acquisitions, or did you have a chance to work with any other companies?
I worked with one other company. It was more the CPA firm I was using had an M&A arm with it, and they assisted with one of them. But the rest of the stuff, I would say I technically worked with Viking on a couple of those. Yes.
Okay. All right. What about them attracted you to realize that I could work for them, or about the process that you went through with them?
Jay and his dad, who since retired and he bought out, had built a solid company that had a great reputation, brand recognition, and a process that was tried and true. Over at that time, it was 24 years. Now we're at 30 years, and we've sold well over 1,000 businesses. And some of the neat things, we've sold the same business several times. We've sold businesses to the same buyer multiple times. A buyer comes in, buys a business from it, then he'll sell it through us, and then he'll buy another business from us, and then he'll sell that business through us. We build we're a business about transactions. That's what the product is, but our business, that's not what we're about. Our business is about the human relationship and what we build with not only the sellers primarily though, but also the buyers. And those relationships, the transactions are just a byproduct. That's just what comes out of it.
Okay.
It's really nice. I had a closing that happened earlier this year, and like most sellers, it's an emotional process. All right, so we play psychiatrist a lot, and talking them off the ledge, explaining things. This is normal. I know how you feel. I was there, and to be able to have that empathy story is definitely helpful. All right, because I was in their seat.
Yeah.
It was supposed to close in 1 month, but it took a month longer just because of some, every deal has issues. that occur, and you just work through them and all that. And she was tough. She was a real strong lady and all that. She was great to work with, and when I saw the wire come with our commission on it, I called her up and I said, "Hey, check your bank account." And she's like, "Well, hold on a second." And she checked her bank account and she started crying.
Yeah.
So you let that emotional release. That it was fun. And she's we stay in touch with all of our sellers. We invite them back to the conferences that we have, and one of the things that I've realized over the 6 years of doing this, and also becoming a certified exit planning advisor, the majority of business owners, when they sell their business, they were okay that they sold their business, but one thing that they didn't think about, and that I have conversations now with them, is the businesses that you own are your identity. So when you get to that point, you're burned out and you exit from that business, and you no longer own that business or running that business, a lot of business owners lose their identity.
Yep.
All right, and that can be a problem, especially depending on the age you are and what else is going on in your life. It doesn't matter what the check is that you got. All right, money doesn't buy everything.
Yeah. It's the same as exiting the military.
Yeah, so we have conversations with the sellers about, what does life look like after? What do you want it to look like? And have those conversations. So when the transaction does go through, there's a positivity on the other side.
Yeah. So do you find yourself in a situation where you might talk people out of selling their business because
every day
they're not ready yet, or like more emotionally? Because like you're saying, and that's kind of what I went through. It's like, all right, I know this is a valuable asset to an extent. It can be more valuable, but then when I started evaluating, like, what can I put the same amount of time into and get the same return on? It's like, man, there's not a lot of options. Like, why do I want to sell this thing now when it's really just getting going?
Very rarely am I going to talk someone out of selling their business, but I'm going to ask them enough questions where they're going to talk themselves.
Right.
All right, whether in or out. If you're ready to sell your business and your business is ready to be sold, two important things, then we're going to sell your business. We're successful at that. But if you physically or mentally aren't ready, I'll ask questions and all that, so they can. You just keep digging and asking the why questions and go further and further, and we can figure out. There's several times where I've said to people, I'm like, I don't know if you're ready to sell your business. I said, why don't you spend the next couple weeks and all that and think about this and talk with your family and the people who are close to you and all that, and then I'll give them a call back in a couple weeks, and they're like, no, you know what, we talked, I'm ready, I know what to do. Or they'll say, you know what, you were right, I'm glad we had that conversation, I'm probably a couple years out. And then we'll stay in touch and update the valuation and all that. I know what the story I tell with a lot of times with the business owners I'm talking to, when I owned my business, it got to a point where my business was for sale 1 day a week. I was like, I'm done.
Yeah.
So whoever wants this, just, I'll take, fine. And then it got to 2 days a week. And then it got to 3 days a week. So eventually it's going to get to 3 or 4 days a week. And, you don't want it to get to that 4 days a week or 5 days a week, because if it gets to that, all right, now the growth is stagnated, and maybe the growth is going down and the profit's going down, and it makes it more difficult to sell the business at the price that the owner's going to want if there's been a negative decline over the last couple of years.
Yeah. It's as part of our, this is a side story, but as part of our process for like cleaning everything up, becoming more efficient, we sold off some vehicles, sold off some equipment, did some different things. And then I had my one truck that's like my favorite truck. And I was like, all right, I'm gonna sell it too. And I put it up by the road, and then I pulled it back. And then I put it up by the road, and somebody calls and says, hey, is that truck for sale? It's like, nope, not anymore. Pull it back in. So it's that same kind of back and forth, that internal battle. Am I really ready to do it? Not ready to do it? How big of a company do you have to be? Do you have to be doing millions of dollars a year in revenue to justify working with somebody like you, or?
No, there's different levels of what we do. People have heard the term business broker, M&A advisor, investment banker. They all do the same thing, just at different levels. The business broker, or they're also known Main Street brokers. There's a lot of small companies out there that specialize, and they sell. The majority of the business they sell are going to have an enterprise value of 1.5 million or below, and which is pretty close to around 85% of all businesses in the United States are going to fall into that bucket.
Right.
And then you have the lower middle market, which is where Viking plays, as M&A advisors or intermediaries, as some people call us too. We're doing businesses with an enterprise value between like 1 and 100 million.
Okay.
The majority of our deals, the value of the businesses are going to be between 3 to 5 million to about 30 to 40 million.
Okay.
And then you have the investment bankers. All right, those are the suits that are deal, and they're really not interested in anything that doesn't have 3 digits in the value.
Right.
It's 100 million and up. Yeah. So we play below them, above. So to answer your question, even if you have a business that's doing $800,000 of revenue a year and you're making about $150,000 a year, you could sell it.
Okay.
There's people out there that are going to buy that business. We're not the ones that are going to sell the business for you.
Okay.
But if you call us, we're going to have the conversation with you. We're going to make sure you understand the whole process and what it's like and all that. And then we have somebody we can refer you to.
I hope you're enjoying the podcast so far. We're so fortunate to be able to book such amazing guests, but booking a guest every week is proving to be a real challenge. And one of the biggest things keeping us from continuing to book amazing guests is they're waiting to see our channel get a little bit bigger and for the interviews to get shared a lot more. So please help us out just by giving this a quick share. If you're enjoying the content, give it a like. This will help get this story out to a lot more people and help us to continue to book amazing guests so we can keep bringing this info and entertainment to you and doing the most we can with this opportunity we have. Thank you. Enjoy the rest of the interview. What do you think is like the biggest mistake that business owners make when they're starting to think about that you find when you get involved in the process? Like in running their business in relation to like affecting the value?
Using their business account as their personal checking account.
Yeah.
That's the number one. Number two is the business owner is too important to the business. So when you have a buyer that's going to come in and they're going to look at the business and they take a look at the financials, I can see how much revenue you got. I see what your cost of goods are and what your operating expenses are. So now you have your net income, at the bottom of your P&L, and that transfers over to your tax return. All right, then you, from that net income, you can start adding things back to it to make that number bigger. A lot of people understand the term EBITDA, earnings before interest, taxes, depreciation, and amortization. What that means is you take the earning, you add the interest that you paid, you add the depreciation that you took, if you have amortization, and taxes, you can only add taxes back if they're like the pass-through entity taxes and all that. And that builds that net income number up a little bit more. And then you can start adding non-business expenses that have been run through the P&L, all right, as add backs that are, for an add back to be a true add back, it has to be on the P&L. It has to be valid. All right, and the validity check of that needs to be an easy lift. So what that means is, the most common, most people are going to have a personal car that they're paying through the business. Not a big deal. All right, you've got car insurance with that. Okay. All right, but then they'll come to us and go, well, I've got all this meals and entertainment stuff. What about all my gas that I put into it? What about, the family trips that we take, and everything's being run through the business? Well, now the validity of those and the validity check of those becomes much more cumbersome for the buyer. All right, and the buyer who's going to use a bank, the bank's going to look at these numbers also, and they're not going to want to spend 3 weeks trying to validate, $60,000 over the year in meals and entertainment.
Right.
So, so you don't want to do that. You want as clean of books as possible. The cleaner the books, when a buyer looks at it, the less risk that they're going to see in the business. It's all plain, right there for them. And then the second one I mentioned is the owner. And at the very beginning of this, I said, you start your business, you're wearing every hat in the business. Yep. By the time you sell the business, the goal, you don't want to be wearing any hats. That you have a management team in place, that you're just more the visionary, or you're just overseeing. The amount of direct reports you have is minimized to as small as you can get. So that way is me, the buyer, coming in to buy your business. I may not know anything about utilities, your utility business and all that, but if you're not doing anything and you're just acting as the CEO or the chairman of the board type of a position and all that, and you've got someone running the finances, you've got someone running the operations, and you got somebody running sales, the 3 major departments in any business. If you have 3 people there that aren't owners of the business, especially, that are there, that are going to continue to run the business, it's very easy for me to buy your business, come in, take the position of you, have a transition with you and all that, yep. Build the relationship with those 3 people that are going to continue to run the business. It's another risk mitigation, and it lowers the risk from the buyer's perspective.
Yeah, so become more of an advisor for your own company, meeting with maybe just the management team, mm-hmm. but not taking your finger completely off the pulse, because that's when things start to slip. Yeah. So finding that balance.
And I know a lot of people listening to this may be of the type of business where, I have to be in the business, and it's just the size of it, you're going to have to. Doesn't mean you can't sell your business. It just makes it a little bit more difficult. It may take a little bit more time because your buyer pool is going to shrink. If you have clean books and you've got, one of the things I'll say is that a lot of people think that your business is valued on, the financials, and it's a multiple of your EBITDA or cash flow. Mm-hmm. Well, that multiple, there's a range there. When you look at comparables that are out there for whatever type of business you have, we'll take the most common. Most businesses are going to sell typically for around 3 times cash flow. Now, depending on the business, that can be like 2.5 to 4.5 times, or 3 to 5 times, somewhere in there. Well, what makes your business a 3X versus a 5X? You get all the financials, the things we talked about, and you kind of run the valuation and see where the numbers are. And you're like, okay, your value range is going to be between, 1 and 2 million. Well, what makes you the $1 million company versus the $2 million company? And that's a 3 to a 5 multiple, let's say. That's where there's 4 other types of capital that come into play in your business. The human capital that you have in the company. This is, talking about those 3 people that you had running mm-hmm. the business, the tenure of your employees, the legitimacy of the employees. Right. And today's world is really big, with I-9s and E-Verify and things like that. And then you also have your organizational capital. Do you have policies and procedures and SOPs on how to run your business that's going to make it easier? I mentioned to you earlier before we started about the Entrepreneur Operating System, EOS, mm-hmm. having some sort of system, all right, that you're running your company on, and that has meeting rhythms and a frequency to everything. Your customer capital. Who are your customers in the customer base? How long have you had them? Do you have paper on them? Meaning, do you have a contract? Right. Do you have a customer concentration issue? Is 40, 30%, 20% of all your revenue coming from one customer? Those are things that are pluses and minuses. And then your social capital. That's social, internal and external. Internally, it's about your culture, all right, and how your business is perceived, all right, by the people that are in your organization. And then you have the external social capital, which is, could be your Google reviews, the reputation of the business. If it's a product, what is the brand recognition of the product or the brand recognition of the name? Right? All of those things, if those are all in the pluses, those are things that are going to take you from a 3 to a 5.
Okay.
All right. And we actually have what's called a business attractiveness scorecard that we take the seller through to have them kind of grade themselves, and they're always going to grade themselves higher than what they are.
Yeah.
Then we'll have the conversation, say, are you really, that good at that? And here's why you probably are this. And we do the score and all that and say, okay, on that 3 to 5 scale, you're coming in around about a 4.2. So that makes your value of your business around here. And we usually, when we take a business out to market and actually put a price tag on it, the price that we're getting for the business is usually within 4% below or above that. So
Right.
A lot of times we'll take a business out to market and at market value where we don't put a price on it. And that's because of the intrinsic value of the business and all that, and the beauty that could be seen in the eye of the buyer. All right, could be a very broad range because you also have different types of buyers that you're dealing with. An individual buyer, which is the corporate person who's coming out of the corporate world that doesn't want to work for the man anymore and wants to be the man, or the slew of MBA grads that are out there that are getting involved with the entrepreneurship through acquisition, clubs and all that they have at every school that has an MBA program. So those are the individual buyers, and they're going to look at a business a different way than a strategic, which is another business that does what you do, that wants to buy your business because you have a product that meshes with what they have, or they do exactly what you do, but they're in Charlotte, North Carolina, and they want to be in Raleigh.
Right.
And then you have the private equity groups, which is a whole lot of different types of private equity groups and how they buy and all that. There's the horror stories that people have heard. Well, I don't want to sell to a private equity group. They're going to come in and fire everybody. That's not true. Human capital is one of the biggest things that buyers look at.
Right.
They fear the employees leaving when the owner sells. So they don't want to get rid of anybody. And for that, on the flip side, last year at our Viking conference, and every year we have a seller panel where we have people's businesses that we have sold over the last year or two on a panel that we moderate. So everyone else, because there's over 70 people in Viking, and we want to make sure that the soft skills are taught, and so they can hear what sellers go through, are going through the process with us. And one of the gentlemen who sold his business, who is now an advisor for Viking out of our Atlanta office, he said something that resonated with me that I use to this day. A couple years ago, is that the number one thing he was concerned about when he was selling his business and all that was not the purchase price. It was that the employees that he had that were family to him
Right.
had a safe place to land
Yeah.
when he left. So we take that very seriously, and we want to look and find that right buyer that's going to match, right, for what that seller is looking for.
Yeah, that's something I'd definitely be worried about is employees, spend so much time and build that team over years, and to think that they're not going to be taken care of on the other side of it
Right.
would definitely stop me from moving forward. There's a couple things you touched on. One I was going to ask about, do you have, for us, whenever you came in and we met, we had already started our process. So we were making a lot of changes focused on efficiency, policies, procedures, making sure we had putting time into a management team, removing myself, like all the stuff you're talking about is what we were working on. Had a plan of about, by the end of a year, really have a plan forward and then implement that over the next 2 years. So total about a 3-year plan for us to get from where we were to where we want to be. And of course things change along that way. Do you find it all that, like, whenever you come in and meet somebody and you give them this evaluation and it's significantly less than what they thought it was going to be, do they take that time to do the right process, or do you see people like, I got to fix everything right now and get that value back?
Well, I would say 7 out of 10 valuations that we do, the number that we give to that business owner is not where they thought it was going to be.
Right.
That's normal. When we talk to them about, this is what it's worth, they're like, well, your business is worth $4 million. Well, I thought it was worth $6 million. Okay. So we have a value gap that we need to work on. This is where your value is. This is where you want it to be. So this is how you're going to get from 4 million to 6 million. All right. And start with, well, as it comes down to that means that you need $500,000 more, let's say, of profit. Well, how are you going to get $500,000 more profit? Well, the easiest way is more sales. Now, and if you're the type of business that you can streamline your operations where you get to a point where your costs become more so fixed costs, and now all the revenue that you're bringing in, instead of 20 or 30% dropping to the bottom line, now you've got 80% dropping to the bottom line, then that number is going to grow quicker. So we'll dig into all those things to see, if you're doing $4 million in revenue right now, and you need to do, and out of that you're getting, let's say, $500,000 of profit that the multiple's being laid on. Does that mean that if you're doing 8 million, you're only going to have $1 million? And let's go through that process. And for every increment, all right, where does your gross margin and all that get bigger, so more money's dropping to the bottom line? Help them put a plan together. If they need to run EOS, we'll get an EOS implementer with them to help them get things like that. If there's a certain type of issue that they're having, maybe it's hiring or training or whatever, wherever their pain point is, we'll work on getting the right referral in place to help them put that together if they don't have the skill set or the want or drive, but they still want that value gap to be decreased.
Yeah.
We'll just work with them to figure out what that is. It's different for there's not a secret sauce that works for every single business. Every business is a little different.
Do you find that the businesses on the lower end of the spectrum, compared to the ones like, say, you have a $2 million business and a $10 million business, do you find that the lower ones have less processes and maybe, the owner might still be more involved and they have a lot more work to do to add value to it compared to bigger ones, or it's just the product and service they're selling that's making the gap?
If you took all the businesses that were doing, well, let's just say you take 100 businesses that are doing $1 million of revenue, and you take 100 businesses that are doing $10 million of revenue, and answer that question. Of those 100 businesses that are doing $1 million in revenue, there's probably 80% of them that have massive inefficiencies that are going on that they could correct, all right, to grow very, very easily.
Right.
Where on the flip side, the $10 million company, that 80% probably drops to 50.
Okay.
Or maybe 40, but
Right.
it doesn't drop to zero.
No, I couldn't imagine it would.
There are businesses that we've looked at that have accidentally, with no clue how they're doing it, are doing $35 million of revenue.
Right.
So it happens more often than you think. There are some of them like, how are you doing $35 million of revenue? It's just the right time, right product, right service, whatever it is. And let's see, there's a lot of businesses nowadays. You touched on what is starting to occur right now. We call it the silver tsunami. Mm-hmm. There's somewhere in the 60% range of all businesses in the United States are owned by baby boomers. Yep. And then over the next 10 years, baby boomers are retiring at like 10,000 a day. So over the next 10 years, let's just cut it right in the middle, 65%. Don't know that that's the exact number, but it's close enough. 65% of all businesses in the United States are going to have a change of control in the next 10 years. The amount of of wealth movement from one generation to another in the next 10 years is going to dwarf anything that's ever
It's
happened.
into the trillions, isn't it?
It is a massive
Yeah.
amount of money. So when you're looking at that, one, the M&A market over the next 10 years, all right, in spite of any political or economical things, is going to happen. It's just a matter of those are just going to be speed bumps that could occur, but they have to happen, all right, because the change of control is going to happen. All right, it's inevitable. Everyone dies, so something's going to happen. So whether that's and that's where you look at what are all the options that people have. Well, you could have a family succession and hand it down to someone in the family. You can sell it to your manager. It's called a management buyout. You can create an ESOP, which is an employee stock option program, where you basically sell the entire company to all the employees, and all the employees become owners of it. That's very structured and all that. And then you have the third-party sales, which is, we kind of help with all of those, but third-party sales is that's what we do, and that's where you run a confidential process, go out to the market, sell your business, and find a buyer for your business. And those that's going to happen a tremendous amount, and we see it every day that we're talking, all right, to somebody. They're like, yeah, I'm done, I'm retired.
No.
It was expected that this silver tsunami was going to start a little bit earlier, but the pandemic slowed it down because there were a lot of businesses that got affected by the pandemic, and they've spent the last 4 years rebuilding, all right, that revenue and that profit to where it was before the pandemic hit, and now it's starting again.
And I think some of the slowdown too is from the next generation not being willing to take over the businesses.
Oh, yeah, there's
Like whether it's in the family or out of the family, but I'm more specifically talking about in the family. A lot of people thought, oh, my kids are going to take it over, and now they're running it longer than they thought, and now they're looking for a different exit strategy.
Yeah, but I will say that the millennial, that group is very strong in acquiring businesses.
Yeah.
They've surprised us, haven't they?
Yeah. You said or another stat I guess I want to run by you would be like 70% of businesses that go on the market don't sell. And I'm wondering if that's skewed because you have people that are trying to, sell it themselves, or people that are using brokers for small businesses that are really hard to sell. What do you think about that number?
I think it's a combination. People ask us, who's our competitor? And we believe our biggest competitor is the DIY, do it yourself. Which I've done it on the buy side and all that. I would never recommend doing something like this on your own, unless you're sitting there and the buyer walks into your door and says, I want to buy your company, here's the check and all that, let's get the paperwork together. Okay, that could be, you're still going to miss out on some things because it's not all about the purchase price. There's a whole lot of details in it. But yeah, the industry average is right around 70% of the businesses that go out on the market don't sell. We successfully sell well over 85% of the businesses we take to market. That's completely on the flip side.
Yeah.
Why is that? Well, we don't take on every offer,
Sure.
every opportunity. Even if someone comes to us and they're like, I want to sell up my business, and we look at it and say, okay, this is what your business is worth, but we don't think your business is ready to go to market and sell. We'll tell people we're going to shoot them straight and go, or what we see a lot of is, and this is unfortunate too, within the industry, we're going to tell them your business is worth $2 million. They're like, well, I want to get $4 million for it. Okay, you're not going to get $4 million for it. Well, this guy over here at this other firm, he said he can get $4 million for it. I'm like, okay. They'll sign a listing agreement with that person and all that, and he'll take it out to market for $4 million and fail.
Yeah.
Because he's not going to find a buyer. He may find a buyer that wants to pay $4 million for it because he really wants the business, but it go back to the two things I told you that are important and all that. Your businesses are worth two things: what someone's willing to pay for it, And the important part underneath that, what a bank's willing to loan.
Finance, yeah.
And there's not going to be a bank that's going to finance a $4 million loan for a business that's only worth $2 million.
Right. And that's where people push on the creative financing side of things, being able to come in and take a business that might not be quite ready to sell and work out some sort of creative finance with the owner finance, or whatever they come up with. What's your opinion on that?
Well, there's a lot of different things that go into play. Along with your purchase price is going to be broken out into cash at close. There's always at least a small portion of seller financing. 10% is very common.
Okay.
There's nothing wrong with that. It tells the buyer when the seller's like, I'm okay with like a 10, 15% seller note. It tells the buyer that they have confidence in the business when they're with them not at the helm. If they're totally against it, they're like, why are they against this? They think it's going to fail if they're not there. It's one of those things. So, and then the other components that can come into play that all depend on a lot of different things on the business, if we would even consider it in the negotiating with a buyer, are earnouts or extreme seller financing for sure. You've got with an earnout, which means that we'll pay you $4 million for your business. We're only going to give you $2 million now. We're going to give you the other $2 million, but a certain metric has to be hit.
Right.
The revenue has to stay steady, and there's certain things in there that we don't like to get our sellers involved with. That, if that metric is the profit of the company, well, you're not running the company anymore. You don't have control of the profit. A buyer can easily run the profit down so that number doesn't get hit. So there's a lot of risk in any money that is going to come after the close. Even a seller note, there's small risk. A very small percentage, low single digits of seller notes go into default. As a matter of fact, the SBA loans, the big SBA 7A loan program, only I think it's 4.3% of all SBA loans go to default. So that's not much at all.
Yeah.
But the more money that you have outside of that, whether it's in an earnout or rollover equity or an escrow that gets held for 12 months and all that type of money, there's some risk involved in whether or not you're going to get it, and how you're going to get it, and when you're going to get it.
Okay. This might be a little off topic, but kind of. I'm very against like the guru model, and that's something we talk about a lot because there's so many gurus out there selling their courses. But I've seen a huge increase over the last year of influencers marketing these courses to talking about the same stats that we are, but saying, I'm going to show you how to buy these boring businesses and do creative financing. You have any thoughts on that whole thing? Have you seen much of that yourself, I guess?
I've seen a little bit of it, and the creative financing, I can teach you how to propose the creative financing. Now find the person who's going to take it.
Right.
Now who needs to take a deal like that? Well, that business owner that we talked about earlier that wears all the hats, right? That has terrible books, that has problems with the business, but needs to sell the business.
Right.
Well, they may need to do 90% of it seller financing and get creative on how they're going to get paid for the business. When we were talking about earlier that every business owner needs to have an exit plan, right, that doesn't include 6 feet of dirt on them, all right, let's even back it up from that. So when you're selling your business, you can either have a controlled sale or an uncontrolled. So uncontrolled sale, all right, means that you were being forced for one reason or another, and it usually starts with a D. All right, somebody died, all right, you're getting divorced, you have a disability now, all right, there's disagreement, all right, between you and your partners and all that. There's something that's causing that sale that has to occur. All right, that's an uncontrolled sale. You're in a force mode, all right, and you're going to accept terms that you may not have accepted previously. But when it's a controlled sale, right, now you have the leverage with the buyers. It's not the other way around.
Right.
So if you have that exit plan, so I want to, this is that you start with your exit plan of not necessarily how long do you want to work. That's definitely part of it. Do you want to own the business? But when you walk away from the business, what is the wealth number that you need from that? See what that is. So now we know what the value of your business needs to be when you sell. When I told you, let's do a business valuation right now.
Right.
All right. Why? Every business owner needs to know the value of probably the greatest asset that they own. And why not know that value of the business? Even if you don't want to sell it,
Right.
you want to know it, right? You have a truck, right?
Yeah.
How much is it worth? You know that all the time, don't you?
Yeah.
Why not know? Do you know how much your house is worth?
Yeah.
Roughly?
Yeah.
So why not know how much your business is worth and use that and track that number as a KPI, all right, on a year-to-year basis. So when those thoughts come into your head or you see a potential D word down the road, right, if you always know what that value is, it's a decision point that you have in your head, right, that you're going to be able to make the decision better.
So that's when people should reach out to you, is like as soon as there's something on the horizon, like, okay, I need to start planning now, go ahead and reach out to you guys? Or at what point in the process do you think never too early?
It's never too early. I mean, if you started your business yesterday, why not reach out to us and have a conversation so you can at least learn all the things that you're going to want to know over the next 5 years on when you're building your business, what the pros and cons are of each thing and how it can affect the value of your business. There is a time in your business, usually at the beginning. I remember when I first started my business, there was no profit coming out of the business for the first 5 to 7 years.
Right.
I threw everything back into the business, and there was no profit. I drove the profit to zero to save on taxes every year. Everyone does that, but eventually you got to stop that. So for everything you do at the end of the year in December to drive that net profit down on your P&L, you drive it down so you don't have to pay $40,000, $50,000 in taxes, $100,000, whatever the number is. All right, we'll just pick a number. You save that amount of money in taxes, great. We do it. Every business owner does it every year. About 2 to 3 years out, probably 3 years out, stop. Let that profit number be as high as possible, because every dollar that that you were saving in taxes, you're losing $4 to $7 of value.
Yeah.
Now, on bigger businesses, if you just saved $100,000 in taxes, you just lost $700,000, up to $700,000 of value in your business. That's a significant amount of money.
Yeah. No, I remember that. That was one thing that you said to me that stuck out, and I knew there was a correlation. I didn't know it was that big.
Depending on the multiple.
Sure.
That's why that number is ranged. Depending on the multiple you're going to get, and people hear these. Oh well, I know a friend or somebody, a friend of a friend. They sold their business for 10 times. All right, and we look at their business and like, you're doing $1 million of revenue and you have $300,000 of profit. Good business.
Right.
All right, better than the average business, but across the country for sure. But a business that's doing, we'll even say a business that's doing $1 million a year in profit is not going to get 10 times. A business doing $10 million in profit is going to get 10x. The bigger your business gets and the bigger that profit number is, the higher the multiple goes. That's why the majority of businesses in the United States are going to sell between 2 and 4 times cash flow, average of 3. Well, like we said earlier, the majority of businesses in the United States, around 85% of them, are worth about 1.5 million or below.
Yeah. Is that because, if you're coming in to buy $1 million business that's running or, making a good margin, that you're still probably going to have to be an owner operator to an extent? Does it play into it?
Yeah, there's a lot of, it's just the way the American economy is built, and it's not a bad thing at all. It's why this engine runs. Just drive down the street and drive from here to US 1 and count the number of businesses that you see.
Yeah.
All right. And now count how many of those businesses do you think are doing $10 million or more in revenue?
Right.
Maybe one.
Right.
And you go in anywhere other than obviously, you know, down one of the main streets in New York or something like that.
Sure.
Right? So when you do that and you duplicate that over the hundreds of thousands of small towns across the United States, you can see why so many businesses are at that value. But people hear in the news, all right, or on Twitter or, you know, TikTok or whatever, that, oh, the business sold for 12 times. You know, that's not realistic for the majority of businesses, but that's what they hear.
Right.
And you know, sometimes it's a difficult conversation and they don't like it. I completely redid the way I do a valuation presentation from an experience I had when, you know, probably the first 6 months that I was doing this. And we used to do the valuation presentation and here's the number and then we'll explain it. One particular, it was a husband and wife. I was like, here's the number. The husband leaned back in his chair, crossed his arms, and completely shut down for the next 40 minutes. Now the wife was engaged, all right, and wanting to understand it, but he completely shut down. Didn't want to hear another word.
Right.
So now I go through how we do the valuation and show them, and they start getting a number, because we do the valuation in multiple methods.
Right.
All right, and you take all of those methods and you weight them accordingly and all that to get here's what your probable value is. So we just do it backwards and back into where they can see that number. Because if they can understand it a little bit more.
Yeah, they don't get that sticker shock without the information.
Yeah, it doesn't eliminate sticker shock, but it helps it.
I got you. Yeah.
I remember the first time I got a value on my IT business, I was like, you've got to be kidding me. I was not happy.
You said you were how many years in at that point?
Probably 10 of the 16 years.
Okay. So we're covering so much information, like, and I think a lot of people don't, like, hopefully they'll take the time to listen to what you're saying. Like, for me, you know, years ago when I was running like my first business, I thought that everybody that wasn't a corporation was pretty much owner operator, right? And I've had to learn over time that, like, oh wait, people invest in businesses, buy businesses, what that actually looks like and means, and there's so much to it. I think there's so much bad information talking about anomalies and all that stuff out there that it gets misconstrued. So like trying to get real facts out, it's definitely something we're working towards. If you could take your process that you do, like from somebody sends you an email saying, hey, I'm thinking about selling my business, to, all right, it goes on, or it's sold. Can you summarize that? Like, I guess without going into too much detail of each step, what does that look like?
Yeah, I mean, the high level steps: evaluation, marketing, getting the marketing material together, going out on the market for your business, getting an offer, going under contract, closing the business.
Okay.
So that's the high level. How long does that take? From the time we go to market and launch it live to closing your business, we average about 7 months.
So how involved do you guys get in the process? Like, all right, you do your initial evaluation and you say, you know, these are the recommendations that we make to get the most return on your changes that you're making along the way. And then do you just back out, let them kind of continue to run their business and try and grow and check back in later? Or do you guys help them create processes? Like, what's your level of involvement in that?
We're typically not going to be engaged with them on a daily or weekly basis on creating those processes. If there's a big enough issue or problem that goes on, all right, there's an expert out there that's what they do.
Yep.
I'd rather them have somebody if that's what they do. You know, we sell businesses,
right,
and we know that's so. Don't take our, you know, we know what we're doing here, but that's not our primary focus. Let's get the primary focus person in there to help that problem that's going to be able to give you another turn or two turns on your profit. So our involvement is updating the valuation on a year or twice a year basis, we're in communication with them on a monthly or bi-monthly basis, getting updates, seeing where they're at, answering questions, having conversations with them. And then when it gets to the point where we have a listing engagement signed with them, we're talking to the seller, if not every day, every other day.
Yeah.
And by the time the deal closes and all that, we're having dinner at their dining room table,
Right.
a couple times here and there, or we know who their kids are and
Get to know them pretty well.
You get to know them really well,
Yeah.
and we get some lifelong friends and some great people that you meet, and it's I'm getting pictures from one company. I sold their audio video company probably about 5 years ago now, and they were here in the Raleigh area, and they were buying they bought a boat that they were fixing up, and they were going to basically sail around,
Yeah.
maybe not around the world, but up and down the East Coast and the Bahamas and all that. And as a gift, when it sold and all that, I got them a compass that they can put on the helm. All right, that it had the name of their company and the date that the company sold and all that. So I get pictures from them from time to time in different areas that they're at, and got a couple phone calls here and there. So that's why do I do this, and why do a lot of us in Viking do this? It's like I told you, we're about the relationships, and it's those things that really keep you wanting to go and continue to do that and repeat it with somebody else.
Yeah. So, and that's I wanted to hear you say that, because earlier you said you're not their attorney. You're not you're just a piece of the puzzle to help them do that, and like still getting an attorney that specializes in selling the businesses, and having somebody like us that can come in and help make sure your books are like as pristine as they can be, and help you create those policies and procedures over a 2-3 year period and implement them. Like there's different parts and pieces to the puzzle, and I was just
we're like the head coach of a football team.
okay.
I mean, we're not going to be the offensive expert, but we know offense. We're not the deep, but we know defense. I may have played quarterback, but I'm not the quarterback for this. So there's a team that you want to have around you, right, when you're going through your exit journey, or transition journey. I don't even like using the word exit a lot of times, because exit seems like it's so finite.
Right.
That you're transitioning to another part of your life. All right. That you want to have the people around you who have been there, done that, all right, and can protect you. And we kind of head coach that, right? And we can make sure that the right financial managers in place, that they, if there's trust or estate planning that needs to take place, depending on that size of the checks that are going to come, they can be significant. All right, and there's significant tax savings that there's ways to do that with different trusts, and you can actually sell your business you can create a trust, sell your business to that trust the day before you close, and the buyer actually buys the business from the trust. So all the money goes into the trust, and then as you draw the money out of the trust, you pay taxes. So it's not a single tax hit at one time. You can extend it over the years. There's a lot of different ways that you can help mitigate taxes and all that. That's where you want a good CPA, a good tax, specialist and state. So depending on the situation and the people involved, the business involved and all that, we can ensure and make sure that the team gets put together the right way.
Perfect explanation of that. And it's the same thing with us. Like if we say we're going to do a business evaluation, people think of putting monetary value on it. We're not going to do that. We don't know the markets. We don't know, the things that you guys know. We know operations. We know, we can come in, evaluate how your business is running on a day-to-day basis and help you put policies and procedures in place. But we're not going to give you, oh, this is what we think your values of your company's worth. We're just a smaller piece of the puzzle. So how do you get most of your clients? Is it referral? Because I guess it was probably different in the beginning, but you guys are an established brand. So is it referrals, people reaching out to you, or are you guys going out and actively trying to find businesses?
All the above.
Okay.
If we about 8 months ago or so, we actually took a look at our entire deal board at the time. I think we had, 62 deals out on the market or under contract at the particular time. And I think it was 35 of those were referrals.
Oh, nice.
So, and we've done it a couple times, and it seems that we're at least probably 50% of the businesses that we're taking out to market were referred to us from either a past seller, a past buyer, or what we call a points of influence, all right, or powers of influence. And those are the relationships we have with the CPAs, the attorneys, the wealth advisors, the financial advisors, the people that we're bringing in on the team. Mm-hmm. All right, they see the job that we do and all that, and they've got other clients and they'll bring them in and say, yeah, I'm thinking about selling my business. I'm like, oh, this is who you need to call. So that happens quite a bit.
Okay.
We have, as a whole, as a group with the different offices, because it's the SEO and the Google pay-per-click is more localized. Every office spends a certain amount of money. As a whole, as the company, we're probably $50,000 to $60,000 a month in pay-per-click.
Wow.
And then we figured it out. We didn't know we were good at it until it started happening. And once we figured it out, we've had our marketing team spend some attention on this. One of the term is going to change over time. They haven't settled on anything, but it's kind of known as the SGEO. So where you've got the GPTs out there, mm-hmm. and all the AI out there, more people today are going into their GPT, the LLM, and asking, I want to sell my business. This is the type of business. Who do I call?
Yep.
Instead of going to Google and asking.
Yep.
So when you go to Google and ask, you get the things, and you got the Google pay-per-click, or you're ranked up on the SEO. We do really good on SEO,
right.
And we spend a decent amount of money to be the sponsor part up there too, everywhere we're at. But we're getting a lot of calls where we ask people, how did you hear about us? So well, I asked AI and they told me to call you. And so we're like, oh, interesting. So we do, and that's a combination of, every deal that we close is out there with the press release and on LinkedIn. We have a lot of blog activity.
Yep.
I post on LinkedIn, I'd say 90% of my posts are educational, and the other 10% are deal updates.
Right.
So there's a lot of us that are doing that in Viking and all. So the GEO with the generative, that's the G, is growing rapidly. Yeah. I sold a interpretations company earlier this year, and a couple of months after that sold, I get a LinkedIn request from somebody. I usually accept most LinkedIn requests, and I accepted the LinkedIn request, and he said, hey, I'd like to have a conversation with you about selling our company and all that. So I shot him back with my Calendly link to get on my calendar, and he did that, and I'm talking to him on the phone. I said, they've got a language interpretation business that's up in the Northeast.
Okay.
And I said, how did you find Viking, or even that directly with me? He goes, oh, I went into GPT and said, I want to sell my interpretation business. And the answer was to call me. Perfect. Not about Viking and me. And why is that? Because I was associated with selling in exactly that same type of business a couple months earlier.
Yeah.
So, so the more, I see that happening more and more now.
Yeah, that's a thing that we've talked about actually in multiple meetings, but also on a couple episodes of the podcast, where that's what all the experts are saying, that putting as much into Google My Business is going to be fading out over the years, and everybody's going to be switching over to the different AI platforms and looking there, and how do you maximize, where you fall. And that's so you're the first one that we've had that's actually seen it in real time. So that's really cool to hear.
Yeah, it doesn't mean that the Google parts of there aren't going to be valid anymore. It's going to be different.
It's complementary, right?
It's
it
complementary.
Still has to pull away. It's got to find the information.
AI's got to get the information
Yeah.
from somewhere and pull it from somewhere. So you just got to have your information in all the places, and learning and understanding where the different GPTs are pulling from. All right, because they don't all pull from the same sources all the time.
Yeah.
And
I think something that's helped me understand it a little bit better, since I'm not dealing with it in real time, is that researching guests coming on here, and then I get to see where AI continues to pull from. And at first, I had to actually train it to make sure you're checking Facebook, TikTok, Instagram. It already pulls from LinkedIn. It's looking for news articles out there, and then getting it to dig a little bit deeper. And now it's pulling from so many different sources, and I tend to get really good information very quickly from that. And I think it's going to be the same with businesses. So I think if this isn't making sense to you, start researching something over and over again in a different way, and you'll start to see how AI works with where it's pulling its information from.
yeah, AI is a whole different story. It's
Complicated.
It's complicated. So just to touch on it, we're looking at, we get economic updates on a quarterly basis from the Federal Reserve. We just happen to be lucky enough to know one of the Federal Reserve guys. So he does an update for us, and it's really interesting information. And a lot of people are concerned about AI taking our jobs from us. The mindset needs to be is, how do I use AI to better my job also? And the other thing is that baby boomers, right? Huge generation, the amount of people in it. That's why it's called baby boomers.
Yep.
So Gen X are not as big, but decent size. Then the millennials, then the alphas. Well, what do we see happening here? There's a decline of the number of people in each generation.
Right.
So if there's a decline in all that, but our economy is going to continue to grow, there's a mismatch that's going to occur. We are not going to have the workforce to fill the amount of jobs, all right, to be able to keep the economy going, 20 years down the road.
Absolutely.
Well, we will, because the AI bots are going to fill that gap.
Yep.
AI is going to actually, in my opinion, is actually going to be our savior, all right, in being able to maintain, that the economic strength that the country has and all that, and it's going to help a lot of other countries too. It will take some jobs, just like the industrial age took some people's jobs, but over time, more jobs were created.
Yep. It all evolves. It's not much different than the assembly line being created. It removed a lot of jobs, and seamstresses became button sewers, or everything went from I do a whole bunch of stuff down to one thing. And it's just the evolution of stuff, and it's scary, and there's going to be impact from it. But the more you can learn about it and the process and how it works, and diving into some of these AI programs out there is going to keep you more relevant. But that's also, I think, where a lot of value is in purchasing a business from that generation, the boomer generation, is they might not be implementing as much AI or technology into it. And if you can come in and understand those processes and be able to implement them, there's instant value into those businesses.
Oh, one of our marketing whenever we build or the marketing document, SIM is the confidential information memorandum is the most common term. When we build the SIM for the document, if we actually speak in every single one of them, the use or lack of use of AI as either a company strength or a growth opportunity.
Right.
So, we'll do that with any company that we're going to sell. If they don't do it, it's a growth opportunity. If they do it, it's a company strength.
Yeah.
100%. Because the amount of companies out there that do zero marketing is baffling.
Right.
I mean, zero. They do business just based on their word of mouth and their reputation, and they do great business.
Yeah.
Different. You've been in this seat. To get to $1 million in revenue, believe it or not, only 5% of all businesses in the United States reach that mark.
It's crazy.
It's crazy, isn't it?
Yeah.
All right, to go from 1 to 5, right, is another leap.
Right.
And to go from 5 to 10 is another leap. All right, the thing that a lot of people got to realize or don't know or don't realize is that leap from 1 to 5 is not 2 jumps. It's 1.
Yeah.
If you try it in 2, you fall, right? The same thing with 5 to 10 and 10 to 20. Those are exponential leaps that are difficult to get across, right? Because you'll see businesses, they'll climb and they'll plateau at $1 million, $1.5 million, $2 million, $1 million, and all that, and they just sit there,
right?
And they never get up. So and then they get up and they get to that 5, they'll do the same thing, yep. And then they'll jump up again.
100%, and that's what we're dealing with, right? But we're trying to take steps to get over that hump, but it's not happening overnight. Like we've been working at this for years now, trying to get to that next level, yeah. And with our utility company specifically. But
one of the better books that I read through my Barnes and Noble MBA years and all that was "What Got You There Won't Get You Here," or what got you here won't get you there.
Right.
All right, and what you take from that is, what you did to get to $1 million is great, but that same formula is not going to get you to 5.
100%. Yeah, I know that for a fact.
You can repeat it, and you might get to 2 million, yeah. And then back to 1. You go back and forth, but you have to evolve as a business owner to continue to grow. And why do a lot of people want to sell their business and all that? They're tired of evolving.
Yeah.
Let someone else do it.
Yeah. Yeah, no, that's awesome. It's a great way to say it too, because even since we've started making the shift, it's like it hasn't been like a steady incline of, revenue. It was, we made some changes, it went up, and then we implemented some more changes that we knew we needed to do, but they were going to negatively affect us. So it went back down a little bit, then back up, and it is. And then I'm hoping that when we get to the end of this and we finish this implementation process, then we're going to see that leap into that next category. You know what I mean? But it's taxing. There's so much that goes into it. I'm trying to think 5 years ahead on every decision I make, or at least 3, because that's the timeline I gave myself. So every decision I make, I'm moving 3 years ahead, and my management team might be like, well, that doesn't make sense. It's like, it will, just wait. But luckily I have a great management team, and they've seen me implement stuff, and at one point they have that light bulb moment, like, oh, that's what you've been working on. Yeah, because I try not to bog them down with all of my ideas. I need them to focus on the tasks at hand while I plan ahead, steps ahead. So no, I like it. I guess I never made that correlation, but now that you're saying it, it's like smacking me in the face.
Yeah, there's a lot of smacks in the face that I got too. With it's like, that sounds, but that's simple. Why didn't I think of that? Or I didn't.
Yeah. Yeah. Now the problem that I'm dealing with is, especially now that I'm starting this business, and this is what I want to be doing. This is what I enjoy doing. I enjoy helping people, helping businesses. I enjoy educating myself, but then educating other people as well, based off of experiences and other people's experiences. So I'm excited about really diving into the consulting business. We're only, I don't know what today is, 148, day 148, what day? 128. Because we only know that because we release a video every day for a year.
Okay.
So we're on 128 of our new business venture, and we're trying to do things a little bit expedited to hit certain goals, but also not skip steps. So that's a hard thing to do. But the part that I'm struggling with is, all right, the utility company, where it's at, it's great, it's stable, it can cruise just like it is, and I have very little involvement. Or I can do the necessary steps that we've been working on and planning, and then there's going to be some level of involvement for me getting back into it as we make a transition, whether it's moving to another market we're getting invited to, or making some changes just in our market. Either way, it's going to require more involvement from me. So like determining, do I go ahead and try and get us to that next level? Is it going to be worth it? What's the timeline? It's just a lot of stuff to take into account.
Mm-hmm.
So not that you have any insight to that, but I guess you smacked me in the face and now I'm venting.
Yeah. We all need a smack in the face every once in a while, you know, whether that's to help us decide, you know, whether is now the time or now not the time.
Yeah.
And both answers are right.
Yeah.
And both answers are wrong. It all depends on, you know, we're selling a business, and you know, I believe this one was, you know, let's just call it 20 million is what the offer was, what was on the table, and we're under contract. And there was a bit of a retrade that was going on. And a retrade is when, after you go under contract, the buyer's going to do their due diligence and all that. If they find something that isn't what they thought and all that, they're like, listen, I know I offered you 20, but you know, we're really we can only pay 18 because of this. And if it's valid, you know, maybe, you know, you take it, and, you know, talk to the seller. It's like, yeah, that's still fair. But they're like, well, you know, I don't know if I want to sell my business for that now. You know, what if he runs it into the ground, and, you know, because he's got like 15% rollover equity. And I'm like, true. I said, if he, you know, if he runs it into the ground, or if you say, oh, well, I'm not going to sell the business because maybe this is going to happen, that if your business is worth 20 million now and you're afraid that he's going to take over the business and he's not going to navigate what you see coming down the road, all right, that's going to happen if you don't navigate it right either. Your $20 million business is now worth only 10.
Right.
So do you want to sell? You know, selling at the right time at the peak, and I shouldn't say that. I'd actually say that's incorrect. You don't want to sell at the peak. You want to sell on your way up to the peak.
Okay.
So if you know you're at the peak and someone else can see you're at the peak, well, what's on the other side of the peak?
Right.
Right. Maybe it's a long plateau or it's a drop.
Yeah.
Right. But there's not a peak. You know, you may not be able to see that. The next peak to climb and all that. So your right time to sell isn't when you've had 3 bad years.
Right.
All right.
That's when you want to sell.
You want to sell. It's when you want to, but it's not when you should. You know, you want to capitalize on a couple good years, all right, with continued growth. And when you are selling your business, we tell this to all of our sellers. When you're selling your business, even when we have it on the market and you're under contract, do not stop running your company. Do not take your foot off the pedal.
Right.
So continue to run it like you're not selling it, because anything can happen with a deal. If you take your foot off the pedal, and in those typical 90 days after you go under contract before you close, if you know, you still need to give the financial updates each month. If that second time you give it, there's like all of a sudden the revenue's gone down.
Yeah.
Buyer's going to go, whoa, hold on.
Yeah.
What's going on here?
So you did throw one term out that I want to go back to, and you said due diligence. Now, you guys do a certain level of due diligence during your process, right? And that gets you to your evaluation. But your due diligence, is that enough for you to say to a buyer, oh, we did the due diligence, it's a good company, you can buy it? Or is there extra levels of due diligence that need to be done on top of that?
I don't, God, if there's ever a buyer we can find that go, yeah, I'm good with what you guys did, that would be awesome. Now, every buyer is going to do their own due diligence, and we want them to do it.
Right.
All right. You almost need them to do it, because the purchase agreement and all the paperwork that's going to be signed, that's created by the attorneys that you sign, if he doesn't do the due diligence, or can say, well, I didn't do it because they said they did it, and then finds after the fact that something was wrong, all right, well, then he's got a case, all right, for you know, fraud or something like that. So no, I want the buyers, they need to do their own due diligence. Perfect. On everything, and there's 3 primary categories of due diligence: financial due diligence, the organizational due diligence, and legal due diligence. Depending on the size of the business, there are ways that you can definitely help the business that you own, that's selling, and do what's called a quality of earnings, all right, report. That you know, there's CPA firms do them. There's a lot of other companies that do those, and to do almost all sophisticated buyers, are going to do a quality of earnings, and they're going to get all the financials. They're going to do a quality. It's going to show them how you make revenue, the quality of that revenue, the gross margins, your working capital, your all the things that matter, inventory, everything, and spells it out and puts it out in an easy, digestible format.
Right.
And to have that Q of E already done by a third party, and have that part of the marketing package, makes your business makes the due diligence part of it be much easier.
Or I guess, what's a typical time frame for a due diligence process?
When you go
Or
under
average, I guess. I know there's no typical, but average.
There's no typical. I mean, when we have a buyer first engage with a listing, and they raise their hand, I'm interested, we have a conversation with them, we vet them out, make sure they're good, sign the NDA, and they get into the data room. From the time they get into the data room and have a conversation or two with the sellers, we would expect within 30 days that they need to put in an offer. And let's move forward,
Okay.
one direction or another. Once you go under contract, the due diligence for the financial part is usually around 45 days. The organizational due diligence is the entire time frame, because the buyer is continuing to learn about the business. Mm-hmm. Not only how has it been run, how's it running now, how does it need to run in the future. They need to learn about the tech stack, the employees, the HR, the benefits, and every little thing in the business. That's the organizational due diligence. The legal due diligence usually starts once the financial due diligence is wound down, because you want to make sure the financial terms of the deal that the buyer offered, said, this is what I'll buy your company, and the seller said, okay, I'll do that. There may be some negotiating back and forth in that. The financial due diligence basically solidifies the financial terms of the deal. You don't want to get into the legal due diligence and start spending money on attorneys until you know that that's good. So the legal usually follows the financials. Sometimes there's a little bit of overlap, but that's only when you've already gotten some reports back and you know that the buyer's like, yeah, we're good. We're just finishing up some final things. Mm-hmm. And the process to close a business when you go under contract, average, let's say 90 days is typical. You can see 120 days, sometimes a little longer if it's a really, if the deal has a lot of hair on it.
It's not your market, but I guess the ones that are either selling themselves or dealing with brokers and finding buyers for smaller businesses to come in as like an owner operator. A lot of them are skipping some of the due diligence process, and like when they call us after they've already taken the store over and they're like, hey, we need help with organizational stuff. And you realize that they haven't gone through they haven't done the books with a fine tooth comb, checked the compliance, risk management, all those things. And it's so much harder after you take over the business to get everything in order, opposed to knowing ahead of time. And we're trying to get people to understand that. But there's a master class that you can give on a business owner and the things that they need to do to sell their business for a maximum value. Right.
There's a whole other master class that you can give on an individual buyer and how they need to approach looking at a business and doing the due diligence on a business to make sure that when day one, when they close on the business, that they're ready to run it.
Yeah.
And there are, one of the things that we do, and it's a difficult job sometimes, is vetting out the buyers and making sure that they are ready to own the business.
Oh, yeah.
Because if we feel that a buyer is just kicking the tire and really doesn't know what he's doing, we're not going to get them into the data room or engage them. They have to prove to us that they're the right fit. Because the sellers are typically our client, so it's our job to protect them.
Right.
And not waste their time. And I don't want to waste their time with a buyer who's not going to go anywhere with it. And there's some red flags that can go up pretty quickly with that.
What kind of things do you look into for that to qualify a buyer?
We usually have a set of questions that go out once they inquire on a business. And the set of questions vary depending on the business, type of business and the size of business. that go out that we want to see how they're going to answer those questions. We also have, on individual buyers, we get a low-level personal financial statement. If it's an SBA qualified company, which means that the business purchase price is going to be $5 million or below, and I believe now it's $10 million and below for manufacturing. That means it's SBA qualified. We've usually already got it pre-screened with some SBA lenders that will do the deal before we even go to market. We'll ask them, do you have an SBA lender? And they're like, yeah, we do. I'm like, can we get a pre-qual letter? So we want to make sure they've gone through and did the stuff they needed to do with that SBA lender that shows that they're pre-qualified. We get that letter and know that they're qualified for that. Then,
Sure.
And that's typical with a lot of business brokers out there that they ask for those type of things. And there's been, I think, 4 or 5 times in the last 2 or 3 years where I have received a pre-qual type letter and all that, and I look at it and something doesn't look right about it, and it's fake. And I'm like, wow, that's interesting. That okay, so you're not qualified, and you want to fake this? You're eventually.
Yeah,
you might get through this gate, but it's going to be found out at some point.
Yeah. Oh, that's funny. Everybody's trying to scam everything these days. It's crazy.
Yeah, they're. Yeah.
All right. I don't want to run you all the way up to your stop time, but just out of curiosity, I love numbers. So what percentage do you think of evaluations that you do actually go to market?
Ooh, 15%.
Yeah. Okay. I was thinking around 10%. Yeah. That makes sense.
Yeah.
So I guess you're spending a ton of time with people that aren't ever going to go to market.
I'm okay with that.
And why? How's that work? Like, why does that work for you as a business?
Couple of reasons. I believe that every conversation is worth having. You never know where the next opportunity is going to come from. And in our case and all that, where the next referral is going to come from. Yeah. I've gotten referrals from people who just weren't sellable at all, but I spent a half an hour with them on the phone, helping them out and showing them this is what you can do, referred them to somebody else, whatever. And 2 years later, I get a call from somebody and say, hey, Joe said to give you a call. And this guy has a business that's worth $20 million. Yeah. You never know. So at Viking across the board, we always want to help the business owner understand their options. If that means having a half an hour or an hour conversation with them, doing an evaluation on the business and showing them what it's worth and all that, we're good with that.
Awesome. All right, we're gonna jump into a couple quick rapid fire questions. What's one deal that taught you the most? And you don't have to say who it was, obviously. But.
Yeah. One deal that taught me the most. I had a deal that we had over close to 400 buyer inquiries on. It was a very sought after company. And we go under contract and we choose the buyer, great buyer, spent a lot of time on which buyer and which offer to take. And a couple things that this deal taught me. Number one, spending that time at the beginning of vetting out the buyers, not only ourselves, but with having the conversation with the sellers on which buyer they want to choose and why. That decision, that discussion, the 2 days of discussion of that to choose that buyer is the only reason this deal closed. Because we chose the right buyer, because no other buyer would have went through everything that happened on that deal. It was one thing after another that went wrong, from tax returns to unknown UCCs that were out there. There were a lot of weird things that occurred that we just had to get through. And not all buyers, or after a while, a buyer's going to go, I'm done.
Right.
All the signs here are saying don't do this, but so that deal taught me, the importance of following the process to a T and not cutting corners, all right, and doing every single part of the process.
Tell everybody where they can find you, how they can get a hold of you.
VikingMergers.com is, you can find me on LinkedIn, Dan Wilson, and VikingMergers.com on LinkedIn also. 919-230-0775.
Perfect.
Is the number.
All right. Is there anything we're missing that you think we skipped over?
No, we went over a lot. I mean, I would say there's probably people going, I might need to rewatch that. What did he say and all that. You can always, like I said, one of those things I just mentioned, dwilson@vikingmergers.com is the email address. Shoot me an email. Let's get a coffee or a meal or something like that, and I can obviously I don't have a problem talking about this.
It's awesome. All right. We end every episode the same way, and because once I figured out my definition, it helped me pick good direction in my business and personal life. So for you, what is your definition of success?
I thought you were going to say what is my definition of stay broke?
Yeah, that's a tricky one. There's a couple plays to that. We don't tell people about this one ahead of time.
What is my definition of success? When you have obtained some level of satisfaction in the goals that you set, that you've reached those.
Perfect.
And I say some level of satisfaction because my definition of stay broke means you should never be fully satisfied and you should continue to always have something to strive for.
100%. Can't think of a better way to close it than that. Thank you so much for your time. We really appreciate it.
Yeah.